we think the Fed needs to do some stuff on the short end of the yield curve to stabilize the repo market. Again, that's not a big thing, but you have to do the easy things before we can expect them to do the hard things. We're looking at the dots. We think those dots, some of them will move into 2023 to suggest that, we're thinking about tapering, and then we think or hope that we may see some commentary in the press conference that suggests that Jackson Hole really is the forum in August when the Fed will get more detailed about their tapering plans. But we'll see. We just have to see where Chairman Powell comes out during the press conference this afternoon.
Yeah, and we're looking at a chart of the 10-year bond yield, Steve, and not to take anything away from the drama around it, but it appears that the bond market kind of already had its taper tantrum a few months ago with that steep rise in rates between November and March, and we've been pretty much flat to even slightly down since then. All of that begs this question. What do we do? Do we change our stock ownership because of this? And if so, how?
Yeah, we were not throwing in the towel on our set of calls. Our view is that inflation is going to last a little bit longer than the Fed expects. We think transitory is right, but we think transitory is a 2-year story, not a 6-month story. And we think it's going to run a little hotter than the Fed expects. Not 70s or 80s style dangerous inflation, but hotter than what we had pre-pandemic. And in that environment, we think that you're going to see that 10-year yield break up towards 2%. And you're going to want to be overweight cyclicals, small caps, international stocks, and dividend payers in that environment. Those are the parts of the equity market that are best positioned. Last couple of weeks have been frustrating, certainly with those yields staying flat or falling a bit, but they're holding 1.5%, and we think the next move is more likely to be towards 2 than it is towards 1%.
Well, we have a poll on that, by the way, coming up a bit later on in the program. I asked that on Twitter, sort of getting the pulse of the people on what they expect. All right, you said the dividend payers, Steve. A lot of companies pay dividends. Can you be more specific?
Yeah, you want companies with high dividends, those dividend yields that are 3% or above, that are growing at a rate of, similarly 3 to 5%. And you really want that, not necessarily, well, you do want it relative to the overall stock market, but relative to fixed income. If you are in an inflationary environment, equity income tends to hold up a lot better and yield much higher yields and returns than fixed income does. And so we think that's a key call. You want to trade away a little bit of that downside protection to get that higher yield in an environment where yield is really hard to come by. So,
do you think
Brian,
stocks will be higher on December 31st they are now, Steve, the S&P 500?
Yeah, we do. We've got a 4,500 target for this year. We've got a 5,000 target for next year. Again, that assumes that inflation doesn't scream and run away.
Shepard Smith here. Thanks for watching CNBC on YouTube.